Mike Santoli over at the Telestrator today, taking a look at junk bond ETFs. What do you find?
Sarah, specifically the HYG ETF. It's one of the big ones. They own a huge index of lower-rated corporate bonds. You see the price on a year-to-date basis has been slouching lower. Now, this is mostly, though, about Treasury yields going higher. So Treasury yields go higher. That means Treasury prices go down. All corporate debt is priced off of government debt. So that's why the price here is down about 3.5% year-to-date. The total return is still positive. At the beginning of the year, an index of high-yield bonds was about 5.8% yield. Right now, it's 6.8. So it's become more expensive, but the credit markets in general have been firm. Look at the next chart, because the best way to gauge the strength of the high-yield market is relative to comparable treasuries. So this is a ratio of the HYG ETF and the IEI, which is basically 3 to 7 year treasuries. It's intermediate grade treasuries, pretty close to what the HYG maturity is. And so I'm just going to point out some. When this chart is going up, it means risk appetites are going up and high yield bonds are outperforming treasuries. So here was the high in January. That was ugly. Here's the high in January. And here's the high right there, October 1st. So you saw that credit did soften up pretty significantly into the lows in October. We've rebounded along with last week's bounce, along with stock prices. High yield does move with stock prices, but you see all this land in here where we haven't yet recovered. So credit markets are softened up a little bit relative to treasuries as gauged by the HYG. It's something to watch. It's not so much at emergency levels, but there's something at this point in the cycle people concerned about whether, in fact, credit is still going to be the friend of the stock market.